Debt is not just a financial tool, it is the invisible engine keeping the global economy alive. Without continuous borrowing, money dries up, markets freeze, and growth collapses, revealing how dependent modern systems truly are. Debt expands economic capacity by enabling investment before profits exist. It bridges present limitations and future potential, allowing businesses, households, and governments to act earlier, accelerate growth, and create value that otherwise would remain unrealized. When banks issue loans, they essentially create money. This new purchasing power fuels consumption, investment, and productivity, making debt central to how modern economies generate growth and sustain continuous financial activity across diverse sectors. Without new debt, money supply contracts rapidly. Businesses postpone expansion, consumers limit spending, and governments struggle to fund essential programs, triggering economic slowdowns that can escalate into severe recessions with widespread unemployment. Debt allows long-term infrastructure projects to exist. Roads, energy grids, and communication networks require massive funding up front, and borrowing enables societies to build these foundations now rather than waiting generations for accumulated savings. Government debt stabilizes economies during downturns by financing stimulus, unemployment support, and public services. These interventions maintain spending levels, preventing deeper collapses when private sector activity declines sharply due to uncertainty. Sovereign debt provides safe investment assets. Investors rely on government bonds to store value, hedge risk, and anchor financial portfolios, making national borrowing essential for global market stability and capital allocation. Banks depend heavily on government bonds for liquidity. These assets serve as reliable collateral, helping institutions meet regulatory requirements while maintaining confidence among depositors during periods of heightened market stress. Corporate borrowing fuels business growth. Companies use debt to invest in technology, expand operations, and enter new markets, increasing productivity and strengthening competitive dynamics that drive global economic development. Household debt, including mortgages and education loans, supports long-term wealth building. Borrowing enables families to access housing and skills that generate future income, contributing significantly to national economic activity. If lending halted suddenly, credit markets would freeze, asset prices could crash, investment would collapse, and countless firms might fail, threatening the integrity of financial systems worldwide. Debt becomes dangerous when it outpaces economic productivity. Borrowing must generate future returns, otherwise liabilities grow faster than income, increasing default risks and placing heavy burdens on both private and public sectors. Central banks influence borrowing by adjusting interest rates. Lower rates stimulate lending and spending, while higher rates cool excessive credit expansion and help manage inflationary pressures that threaten economic stability. Modern economies rely on fractional reserve banking, where banks lend more than deposited. This system multiplies money creation, but requires strict oversight to prevent systemic risk. Confidence is essential for debt-driven systems. If trust weakens, people withdraw funds, causing liquidity shortages that can destabilize entire banking networks and restrict credit availability. Debt markets help price risk across the economy. Bond yields guide borrowing costs, influence investment decisions, and signal expectations about inflation, growth, and monetary policy. Without debt pricing mechanisms, investors struggle to measure risk accurately. Markets lose efficiency, capital misallocates, and financial planning becomes unpredictable, weakening economic performance. Trade finance relies on debt instruments, enabling importers and exporters to transact securely. Credit ensures goods move across borders smoothly, supporting global supply chains and international economic integration. Debt acts as economic fuel, accelerating development ahead of actual earnings. Societies can invest in essential projects now to generate future prosperity, avoiding long delays associated with savings-based growth. However, borrowing must remain productive. Using debt for consumption rather than investment reduces future capacity to repay, increasing vulnerability to financial crises and economic stagnation. Aging populations heighten reliance on government borrowing. Declining workforces reduce tax income, forcing states to issue debt to maintain pensions, healthcare, and social safety systems. Debt creates deep global interconnections. When one nation's bond market suffers, losses spread through banks, funds, and governments due to intertwined financial holdings, amplifying systemic risk. The 2008 crisis demonstrated how excessive private debt destabilizes economies. When mortgages defaulted, banks suffered huge losses, credit froze, and global recession unfolded rapidly. Debt influences currency strength. Countries with trustworthy debt attract investment, boosting currency value and enabling cheaper imports that support domestic purchasing power. Nations with weak fiscal credibility face higher borrowing costs. Investors demand greater yields for risk, making development projects expensive and slowing progress that could improve living standards. Economists argue debt helps smooth economic cycles. Borrowing during downturns and repaying during growth periods stabilizes employment and reduces volatility across markets. But excessive borrowing limits future flexibility. High debt restricts public investment, reduces policy options, and increases vulnerability when unexpected shocks hit the global financial system. Healthy economies align debt growth with productivity. When borrowing supports innovation, education, and infrastructure, future gains exceed obligations, ensuring sustainable financial expansion. Developing nations struggle to access affordable credit. High interest rates hinder infrastructure growth, weaken competitiveness, and suppress economic opportunities for millions of workers and entrepreneurs. International institutions provide loans for development, but poorly structured debt can entrap nations. Excessive obligations limit sovereignty and reduce government ability to implement independent economic policies. Despite risks, no advanced economy functions without debt. Credit allows innovation, funds public programs, and supports complex financial markets essential for global prosperity. Debt enables entrepreneurship by giving innovators capital to test ideas. Startups rely on borrowing to develop products, hire teams, and scale operations before generating consistent profits. Housing markets rely on mortgage debt. Without long-term financing, home ownership would plummet, construction would diminish, and entire sectors supporting real estate would shrink dramatically. Public debt supports national defense, education, healthcare, and transportation. These essential services shape human capital, security, and economic productivity, contributing directly to long-term national growth. Large corporations issue bonds to raise capital efficiently. This borrowing helps them compete globally, acquire assets, and fund research that drives technological advancement across industries. Short-term business loans support payroll, operations, and inventory cycles. Without credit, companies face cash flow shortages, threatening employment and economic stability. Consumer credit boosts demand for goods and services. Borrowing spreads spending power across time, supporting retail sectors, manufacturing, and service industries that depend on consistent consumption. Banks use interbank lending to maintain liquidity. These short-term loans keep financial systems functioning smoothly, ensuring institutions can meet obligations without disruption. Debt supports innovation in science and technology. Advanced research requires substantial funding long before commercial returns appear, making borrowing essential for long-term breakthroughs. Global infrastructure projects, such as ports and energy systems, require international loans. These investments connect economies, enhance trade, and strengthen global economic cooperation. Financial markets rely on debt derivatives to manage risk. These instruments distribute exposure across institutions, reducing concentrated vulnerabilities, but also creating hidden linkages capable of amplifying shocks when unexpected events disrupt liquidity or credit conditions globally. Debt enables countries to respond quickly during crises. Emergency borrowing funds healthcare, stabilizes banks, and supports households, preventing economic collapse when sudden disruptions threaten national stability and the broader global financial environment. Stable debt markets encourage long-term investment. Predictable borrowing costs allow companies to plan ambitious projects, allocate resources effectively, and maintain strategic direction even when markets experience temporary volatility or uncertainty. Pension funds depend heavily on government bonds. These low-risk assets provide consistent returns necessary to meet retirement obligations for millions of workers, reinforcing the structural importance of sovereign debt in modern economies. Debt encourages international cooperation. Nations holding each other's bonds develop mutual interests in stability, reducing incentives for conflict and promoting diplomatic engagement through shared financial dependence and coordinated economic strategies. Foreign investors buying government debt strengthen capital inflows. These investments support currency value, improve national liquidity, and reduce borrowing costs for domestic projects that stimulate long-term development. Technological transformation is supported by debt, allowing industries to modernize equipment and processes,